Visa is an almost perfect stock. It is one that you need to consider strongly for your own portfolio. Today's episode, we're going to talk about what we love, what we don't like as much, and ultimately the price that we would be looking to add this company. As always, we'll look at the historical performance of Visa. We're going to talk about their dividend safety, but ultimately their underlying financial metrics like their free cash flow, their debt levels. We also want to bring you up to date with anything you may have missed from their latest investor presentation, the very strong growth they have, as well as the guidance. We also want to take a look at what the insiders have been doing, both buys and sells, talk about those movements, and we want to look at the institutions for the exact same reason, see whether or not in the more recent quarters they have been adding to this company or maybe they've been selling. And very importantly, something that we don't always do, we want to see how well Visa have been performing against the S&P 500 over the longer term. Is this one that you can bet over the long term will continually outperform something like the S&P 500, an ETF which gives you more security? And we want to look deep into the numbers, what we love about this company, their growth consistently, top line as well as bottom line, revenue, net income, as well as the health of this company. As always, very important, their cash versus their total debt. And as we mentioned, it is very important to understand, even though this is a very strong company, what price we would look to buy it at. We'll run it through the valuation model, get to our intrinsic value, get to our acceptable buy price. Now remember, we'll incorporate our margin of safety, and we'll also look towards Wall Street to see what they're forecasting over the next 12 months if they agree that this is a strong company for some very big future gains. Now first, let's take a look, just remind ourselves of the historical performance and some targets. Firstly, there's a double buy rating, Wall Street and Seeking Alpha, although we note a hold from Quant. It is trading towards the upper end of the 52-week range. Visa is typically a company that doesn't trade with a large margin of safety. And we also note the forward yield, 0.76%. We'll talk about their very strong dividend growth year on year, and a forward P, 27.35. To put it in perspective, the S&P's forward P right now does sit around 22. Now, over the last year, very strong performance, up 23.3%. But if you've been a long-term shareholder of Visa, you would be up over 406%. Bear in mind, even though the yield is fairly small, if you were to reinvest that over the last 10 years, your performance would be a lot better. Now, in terms of the first thing that we love about this company is the growth on the top line. Typically, as we say, we look for a 3 to 7% minimum baseline growth. Well, they reported $12.7 billion in 2014. 2023, their latest annual accounts, $32.7 billion. So we can see their growth consistently year on year moving in the right direction, something that we always want to see from any company we invest in. So straight off to a good start. When we take a look at their bottom line, a very similar pattern, $5.4 billion of net income in 2014. Over $17 billion in 2023. So we can already see over 3 times growth on the bottom line over the last 10 years. And again, very similar to their top line, over the longer term, their net income is increasing in the right way that we want to see from any company that we are considering adding to our portfolio. Then what's also important to look at in companies is the health. So a quick cash versus total debt. In terms of cash and short-term investments, just under $4 billion in 2014, 17.7 in that latest report, and we can see again their cash is a position that they do increase over the longer term, year on year, quarter on quarter. How does that compare then to their total debt, numerically and directionally? Always important as part of our analysis. And what we can see is zero debt in 2014. Right now they hold around $20.6 billion. So in fact, their total debt position isn't too far off the same amount that they hold as cash. And we can see here, over the longer term, it has been pretty much inconsistent, some years higher than others, so relatively little theming there that we can talk about, whereas with the cash, we do see it increasing over the longer term. What's also important is to compare how they've performed on an earnings per share versus analyst targets, as well as forward looking. What we note over the last 4 quarters, a 100% track record. They have beaten the analyst targets every single quarter. So that is a very good statistic. So it does give you faith with their analyst targets in the future that you should have some confidence that they will beat. Over the next 3 quarters, they are anticipating double-digit increases to the earnings per share year on year. We can see Q2, however, a high single digit of 7%. And if they do hit the earnings per share September 2025, then the forward P will sit around 24.34. So Always good to incorporate this into your own investment analysis, and what we can see about Visa is they are very consistent, not just in their top line and bottom line growth, but also in their earnings per share targets, as well as hitting them. Now, valuation, the first thing we want to point out is, yes, it may have an F grade, but when we do take a look at the detail, they are trading now at around a 27.35 non-GAAP basis. Now, what we do take a look at here is the median. Now, 10.58, one thing I would say is when we do take a look at this company, they are doing a lot better than the sector median of companies. So I would say an F is very, very unworthy of Visa. And as we can see at the other metrics as well, this shows us that the sector median as a whole isn't performing as strongly as Visa, as we are about to see now. But if you do want to look at any of these metrics, incorporate them into your analysis, you can quickly see them on screen. Now, this is what we mean in terms of the growth. They do get a B+. Now, yes, sector median, they are trading at a much lower valuation, but we can already see year-on-year growth with Visa, 10.2%, sector median at 4.46. This growth is expected to continue, 10.6, with the sector median at 5.2. And one of the things that we always draw your attention to is the earnings per share over the longer term. Year on year for the next 5 years, growth is expected 13.14%, whereas others in the sector on a median basis, 9.56. So whether or not you believe right now that Visa is worthy of this high valuation, let's move on to the third section, which I believe you will agree it is. Profitability, they get an A+. Now, not many companies, if any, do let me know, that are as good as Visa in terms of the profitability aspect. Gross profit margin, 98%, sector median, 59%. Bottom line, 54%, as we can see the sector as a whole, 23.21. So already we can see where this is justified on the profitability. You may argue that the valuation is still expensive, which is completely fine. The point here is to show you that Visa is worthy of being a higher quality company than others in the sector, purely based on these metrics. Cash from operations, 21 billion, with others around 164 million. So to wrap this part of the analysis up, Seeking Alpha and Wall Street consider Visa a buy, Quant consider this a hold, valuation F, growth B+, and profitability at an A+ rating. Now, Visa, how does it compare to others in the industry, in particular their close competitors MasterCard? We have others here, Pfizer, PayPal Holdings, as well as a few others. In fact, we have reviewed all of these on the channel not too long ago. Over the last 12 months then, we have Visa here up 24.22%. Remember, this includes reinvesting those dividends. Pretty much in the top 3, top 4 of their competitors, not too far off that of MasterCard. When we expanded over the last 5 years, we can again see in the top 3 up 75%. MasterCard does marginally outperform. And when we expanded over the last 10 years, in fact, we can see Visa is the second best performing, up 449%. MasterCard marginally higher, 514. Now, I would say any investment that I have over a 5-year period, around 400 to 500% is very, very strong. But remember, do not base any forward analysis or any expectations based on how they have performed in the past. Just something to take a look at for our own part of our analysis. The other thing that we want to draw your attention on is whether or not Visa has outperformed the S&P over the longer term. Now, year to date, we know that Visa has underperformed 5% with the S&P up 11%. If we expand this over the last year, again, we see the S&P up marginally higher, 26.27%. Over the last 5 years, we notice the S&P up 92% versus Visa's 75%. And when we go as far back as 10 years, we see the S&P up 171%, Visa significantly better, 449%. Now, it's difficult to say in the future whether or not Visa will outperform the S&P 500, but when you do zoom out over the longer term, Visa is a very strong company, and we do believe that even if you don't have this as a single stock, but what we can quite clearly see is that over the longer term, Visa has been a very strong company. So let's take a look at insider movement, 0.19% ownership. We noticed 6 insiders sell over the last 12 months for around 66.5 million. So the first one that we see, or the most recent we should say, in quarter 2, just under 10 million, and we see around 13 million in quarter 1 of 2024. So quite some sizable amounts. When we take a look at who these are, well, in fact, we can see the insider on the 15th of May, so not too long ago, sold over 25,000 shares. An average price, $277, over $7 million. And we can in fact see at the end of April, the director, Lloyd Carney, did sell just under 1,000 shares for around $250,000. Information is there. I wouldn't say this is necessarily a bearish signal. Insiders do sell for many reasons, personal, financial, but you can quite clearly see there has been a lot of insider selling over the more recent months. In terms of looking at institutional ownership, well, over 82%, we do see 50 billion worth of sales by these institutions over the last 12 months, but we see a significant amount more of buys, 502 billion. But what we will draw your attention to, a lot more selling by the institutions in quarter one of 2024 than buys, 16 in fact versus 5.26. Now, whether or not you want to include this in your own thesis, we wouldn't say copy them, always do your own due diligence, but we can notice a trend in the more recent period. Insiders have been selling a lot of shares, as well as institutions have been selling a lot more than they have been buying. Now, before we do jump into the dividend safety, let's take a look at their latest investor presentation. A few key themes that we want to draw out. So the first thing we want to look at is the year-on-year increase from the revenue and the operating expenses from the same quarter last year, and on an adjusted constant dollar basis, we do notice that both are up around 10%. More specifically, what we do want to point out is that in terms of the quarterly change, their revenue is up 10%, their bottom line is also up 10%, their earnings per share up 12%, and as we can see on a non-GAAP basis as well, 17 and 20. So very strong. In terms of some of the key drivers, so some of the key performance indicators as well, their payments are up high single digit, their cross-border volume excluding intra-Europe again up double digits, and we can see their processed transactions up 11%. Now, this isn't something that we're surprised about. If you do look at Visa quarter on quarter, year on year, you do get a lot of consistency with this company. You know what is coming every single quarter. And as we said, their track record sitting at 100% over the last 4 quarters is a very good sign of where this company has been and looks to be headed in terms of the numbers. The other thing that we always love to look at is the free cash flow. This is a company that has a lot of free cash flow, as we're about to do a deeper dive on. We can see the free cash flow just for the quarter 2024, $4.3 billion, and in terms of quarter 2 2024 year to date, 7.6. The other thing that this company does is going to look a lot better on a graphical basis that we're about to see, but both share buybacks as well as dividends, returning a lot of excess cash to investor pockets. What we want to look at is the next quarter, so Q3 of 2024, as well as their full year 2024 outlook. Top line growth, low double digit, as well as for the full year. Operating expense in the low teens, low double digit for the full year. And in terms of their earnings per share growth, higher end of the low double digit, full year low teens. So very strong overall. Do expect with this company double digit growth over the longer term, as we saw throughout all of our analysis. This is one of the reasons why we love this company, a lot of consistency. Now, we also do want to point out we have released our latest free weekly article. If you want to gain access to this or any other articles, all completely free, do click on that pinned comment below. For example, if you want to look at 20 undervalued stocks to consider for the portfolio, or how to find undervalued stocks, the websites and resources, you can do that all by clicking on the pinned comment below. Now, dividend safety, no surprises. 99, very safe. Market cap 545 billion. This is a mega cap company, and we can see, again, no surprises. It was just reaffirmed a few weeks ago that a dividend cut for Visa is highly unlikely. Now, how did they perform in the last recession? Well, they increased it during the 07-09 Great Recession. They had plus 10% sales, above the average of essentially negative 12. So looking very strong if you do believe a recession is around the corner. In terms of dividend growth, well, again, one of the reasons we love this company, double-digit growth pretty much every single year and on average over the last 10 years. And this is also a company that has been increasing those dividends for 15 consecutive years. Now, dividend yield theory, for those that are new, does state a company is undervalued when the current yield sits above the 5-year average. As we can see, our first sign of undervaluation, another sign here with the forward P 26 versus the 5-year of 29.1. Just bear in mind, we're not looking at any of these models in isolation, and we will conclude shortly. But we do know, as we mentioned earlier, the sector P does sit much lower at 11.4. So let's take a look at the payout ratio. If you're a regular viewer, you know we always focus on the free cash flow, below 60% as well. That does give us faith management can offer those double-digit increases we've come to love with Visa as well. What we can see, pretty much below 30% consistently over the longer term, 19% in 2023, 21% anticipated in the next full year, so no worries here whatsoever. Free cash flow, as we said, invest in companies that increase consistently over the longer term, and as we can see, more than 3 times growth over the last 10 years, anticipated to continue into the full year 2024 as well. Sales growth, just another format in percentage to what we saw earlier, 3 to 7%. Granted, that COVID year was very poor for the majority of businesses, so we do see it as justifiable. Last 3 years, very strong, trailing 12-month 10%, and as we saw on their forward guidance, they do anticipate a very similar number into full year 24. So this is what we saw earlier, the growth on the top line. And as we mentioned, with shares outstanding, they do a lot of share buybacks consistently over the longer term, pretty much every single year. And what this does is gives you a greater portion of control over the company that you do hold. ROIC, phenomenal. One of the important metrics that I always like to look for, 10% or more, gives us faith management are able to effectively allocate their capital. Very strong over the longer term, pretty consistently as well in the 20s. Last 2 years, though, looking very nice. Trailing 12-month, 35%, making this incredibly attractive to potential investors, as well as those shareholders who want to add more to their position. Operating margin, phenomenal, as we looked at earlier. Not only very high in the mid-60s, but operational efficiency going from 64% increasing to 67% over the last year. Same to be said for the free cash flow, absolutely phenomenal. In the low 60s just over the last 3 years. This is a very strong metric that shows you how good this company really is. And finally, the net debt to EBITDA. Remember, earnings before interest, tax, depreciation, amortization. These below are the number of years it would take the company to pay off all of their debt net of cash on hand. Below 3 is what we want to see. 0.05 in 2023, 0.11 in 2024. They have a phenomenal balance sheet. And remember, this shows us the correlation between balance sheet strength and dividend safety. So no worries so far. So as we said, very, very strong company. There are a few areas that we would like to see a bit better, but overall one of the best companies we have looked at in detail. So as always, let's jump into the valuation model. If you do enjoy the content, values provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So the first model we're looking at is the multiples valuation model. We have MasterCard, which is a very similar company. We use that P multiplied by the EPS of Visa to give us an intrinsic value showing undervaluation. Just bear in mind we're not looking at this or any other models purely in isolation. We then have the dividend discount model. Average growth rate looking very strong over the last few years, 15.88%. Forward looking a lot more conservative, 7.25, and we get an intrinsic value, a second one showing undervaluation. We then move on to the DCF model, free cash flow growth year on year, average at 16.5%, forward looking incredibly conservative at 8%. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and as we can see, a very strong undervaluation from what we do believe to be one of the more accurate valuation models, and this is based on a growth rate of 8%. So when we get to the intrinsic value, remember it is the average of these three models, and for today's episode of Visa, it does come to $319. Do remember you can click on the pinned comment below, grab a copy of this valuation model, getting to your own intrinsic and acceptable buy price companies in your own portfolio, as well as those on your watch list. So margin of safety then, as always, we start off with 10%. We only execute on this if we believe it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that for Visa, a buy up to $287 at 15%, pretty much at the current trading price. So in today's episode, we do see Visa at a 15% MOS, but that is based on our estimates and judgments. In terms of Wall Street and their forecasts over the next 12 months, well, they see the upside of $318 and 17% in terms of implied upside. As we saw at the beginning, Wall Street and Seeking Alpha analysts do consider this a buy now. Now, in terms of the quality of this company, 15% margin of safety is pretty strong. So this could be one that maybe you are already dollar cost averaging into. If you were looking to do a lump sum, then maybe you might wait to around a 20% margin of safety at $255. But as we said, right now, a 15% MOS level is pretty good for a company of Visa's high quality standing. It is very hard to time the market. And in fact, history has shown that when the market is at all-time highs, you do tend to perform very well over the longer term. As always though, do let me know your thoughts below. A lot of people continue to say they are waiting for a massive crash before adding high quality companies like Visa, like MasterCard. But there are also a lot of people that I know that are dollar cost averaging in. And my opinion would be, if there is a company that I believe to be high quality, like Visa, and the valuation does show a nice margin of safety, then dollar cost averaging could be the best option. As always though, let me know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.